The resiliency of stock markets has surprised most market participants given policy and economic uncertainty. Our next guest remains bullish on the Canadian market heading into year end, but worries of euphoria down south. We are joined now by Patrick Horan, portfolio manager and principal at Agilith Capital. Good morning. Thanks for being here.
Good morning.
Patrick, let's get into it
Thanks for having me on.
and why you're so bullish too on the Canadian market right now, and some of your, again, at least at this point too, a little bit of a sell-off yesterday and this week tougher, but it's overall, especially through the end of October, things have been very good.
Yes, they have. Surprisingly good. I think what keeps us very constructive on the Canadian market is that it really hasn't participated in the bull market at least over the past 7 or 8 years. It has recently, and we believe that the Canadian market has a number of cyclicals that are particularly cheap. When the world kind of grew its consensus that interest rates were always going to stay low, there were areas of the TSX, the cyclical areas, the value areas, that got particularly hurt, and they still are very good value here, even though their earnings are good and and they benefit from inflation. So we really like the Canadian market. We think it has a lot more to go, and we believe it's going to outperform the U.S. market, which in our view is the most important factor of all.
Yeah, which is interesting. I'm not sure you're necessarily alone in that, but maybe not necessarily the majority of people in that. I want to talk about in particular too. You like grocers right now too. Saw a big year, but let's break down a little bit for this Canadian market too, and the grocery business.
Well, we actually are short the grocers.
Okay.
So we actually don't like the grocers. We think they're expensive. Loblaws in particular trades at somewhere around 19 or 20 times earnings. I think the grocers have benefited from food inflation over the past few years. They've also benefited from, quote, the safety trade that has been going on with ultra low interest rates. Well, that regime is now gone. We now live in an inflation regime. So, part of their standing is a little weak here. What we believe is going to help propel the grocers down from here is a strong or a weak U.S. dollar, strong Canadian dollar. So they won't have food inflation necessarily to pass through to the customer base. They'll have to compete more and more on steady prices. We also see a lot of the U.S. grocers continue to put store frontage and tonnage into the Canadian market, and that ultimately is going to heat up competition. So expensive, I would argue not as defensive as they once were purported to be, and what we believe is a long-term weak U.S. dollar story. They're a good play for a short side. So for most of the people who have them in your portfolio, I would be cautious here. We think, I've seen the grocers. I've been around for 35 years, almost 40 now. And I've seen the grocers trade down to an 11 times multiple on earnings, and they all trade well above that. So so we think they're going to round trip that multiple.
Okay, I'm curious your thoughts too, your position on Constellation Software and also on Thomson Reuters too, and where you stand at least on this for the maybe the short term and possibly long term.
Yeah, well, so we think again, you're picking out all my shorts, I guess. These are all brand new shorts for us. We have not had these many short positions, and we basically have been layering them on for the past couple of months. So Thomson and Constellation, the investment theme to own them is they have fantastic moats, resilient moats, and it's going to be very hard for companies to penetrate those moats. So they have artificially high margins as a result of their leverage over their customers. Constellation is a little bit more of a serial acquirer. where they aggregate in and they get the benefit of cash flow, and then they integrate it into their existing system, and voila, you get positive leverage. They're both great stories. They're both, fantastic business models. Having said that, they both trade at unbelievable EBITDA valuations, earnings and EBITDA valuations, meaning that super, super expensive. The last time I
Hmm.
saw these kind of valuations was, back in the dot-com bust, and I swore to myself as I went through that, and I had some of those names in my portfolio, I would never do that again. So this time I'm on the short side of that, and we believe that they have a lot of growth. So Thomson just reported yesterday, they talked about 7% revenue growth kind of thing. That just doesn't support a 22 times EBITDA multiple. There's
Hmm.
so much more growth that has to come in to justify that. And when you really look at a free cash flow analysis, these companies have a lot more growth to come before they can justify where their multiples are at. So we think the time has come. AI is also a very big factor here. No one really knows how AI is going to unfold. We certainly don't. We think it's a good tool for productivity, but more importantly, it will take down some of these older barriers to entry and provide a cheap way of accessing new customers. And we think ultimately Constellation and Thomson will both have a possible erosion
Hmm.
to those high barriers to entry from AI. And so it's a risk that we're not going to see it in their results probably for a year from now. But when expensive stocks face risk, they go down, and
Hmm.
I think that's what we're seeing today.
Patrick Horan, portfolio manager and principal at Agilith Capital. Appreciate your time today. Thank you for this.
Thanks for having me on.